Hello again, and thank you for joining us. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Today is Thursday, March 16th of 2023, and thank you for joining us for our market insights and observations. We're going to talk about the three topics that are moving markets. We're paying attention to, so you should be too. First and foremost, next week we have the Federal Reserve, and there's been a lot of this is the kickoff to March Madness, and the day before St. Patrick's Day, so happy St. Patrick's Day, but more importantly, the March Madness. And I don't mean basketball, even though I hope you had your tournament bracket filled out prior to our filming of today, because the tournament's kicked off. The March Madness I'm referring to is essentially what's happening in the banking sector, and we're going to talk about that, and ultimately the Federal Reserve and their role in this, and how we got to where we are today over the last 2 weeks of sort of the headlines that we're seeing in the financial markets. Also, we're going to be discussing the de-inverted yield curve. You've heard me talk about this over the last 6 to 9 months. The inverted yield curve, well, that's reversed. And we're going to talk about why and what the implications of that will be. And the recession watch is back in full effect right now. But let's get right back to the, sort of the topic of what we're seeing the last 2 weeks is unprecedented. Actually, we've seen it before where the Federal Reserve and the U.S. Treasury all get together in the administration and made some emergency moves last week to save SVB, Silicon Valley Bank, with regards to ultimately above SIPC level. Now keep in mind, SIPC is on your bank deposits, $250,000, and you're insured above that, especially on the regional banks. You got to pay attention and be mindful of your deposits. So make certain that your bank, sort of what you have at the banks, the small banks, if you will, are well sort of in the ratios of insurance coverage. We've seen at Blanke Schein Wealth Management a lot of influx of just that, the bank cash. And the reason why is what I've discussed for quite some time on my market insights and observations. I constantly talk about the U.S. Treasury yield curve is basically one of the best deals in town, if you will, when it regards to we had treasuries yielding on a short-term basis, so 2 years and less, before last week, well over 5%. So that's really what sent the sort of the crisis in motion with regards to the banks. Because if you're at a bank and you have money above the 250, even what you have in the banks aren't paying. And across sort of the banking sector, banks are seeing deposits being withdrawn to be put into treasuries because that spread, that yield of 4.5%, 5%, the banking system was not paying those deposits. Those deposits were being depleted. And we saw over the last 6, 12 months a huge influx of just that, just a cash management account we set up in treasuries, even short-term, liquid, backed by the full faith and credit U.S. government. We buy even discounted treasuries, and we're earning money on our bank deposits because now we're well within sort of the SIPC limitations because we keep the cash under that, and then the investments, you have the bond, the treasury bond in your account. So you're covered as it relates to sort of the insurance levels when you employ a strategy as we do for clients that are looking for sort of alternatives sort of to their bank cash. We keep it liquid and you can still use it, but that's still going to be a persisting problem in the banking sector, especially on the small and the super regionals, and we're seeing the pressure there. The good news is that the regulators and the Fed and sort of in Washington has proactively sort of jumped on this last week. And there's going to be the moral hazard conversations as we had 2007, 2008. Should they have, or did they, or who's next? The good news is at this moment in time is they are being proactive and they are being quick to make a decision. In fact, 2007, 2008, there was sort of the slow-moving chain reaction where even the Congress couldn't approve sort of the bank bailout back then. And then once that happened, the proverbial SY hit the fan at that moment in time. Now, since laws have changed, they proactively made some moves. The Federal Reserve has some tools, and the Treasury has some tools, sort of clubs in their bag that they used sort of in the wake of this. Now, what does all that mean? Well, as we've been describing, the 2-year Treasury, which was at 5% last week, now it's in the 4s and coming down, was higher yielding than the 10-year Treasury. So if you see sort of, that's called an inverted yield curve. So let me do this for you. So the 2-year and the 10-year. So you have a short-term higher yield and a longer-term lower yielding environment. And historically and traditionally, that is signaling that the U.S. economy will eventually hit a recession. And that's essentially what the Federal Reserve has done. Another sort of topic that I've brought up several times, if you've watched and followed along, is the Federal Reserve is going to hike rates until they break something. And they just broke something last week because this sort of imbalance, people will find, and money will find, smart money will find sort of the better place for their money to start earning higher yields. And that's essentially what's happening in the banking issue right now. Now, right now we have the most inverted yield curve, meaning short-term interest rates on the Treasury market are higher than the long-term. And that's the most that we've seen since 1981. Okay, if you go back here, and this is where we are in terms of an inversion, historically speaking, what you'll notice on the chart here on the green is every time you get below this line, and that indicates this line right here, it indicates the inversion. Okay, and we see that right there. And it happened early 90s, it happened in 2000s, it happened in 2007, 2008, before the financial crisis, and it happened in the early 80s. This is where we are today, the most it's been inverted since 1981. And now what you're going to see is the gray bar. The gray bars are, that's back in 2000 with COVID, or 2020 with COVID. This is the question mark right here. Are we going to see, historically speaking, every time, 1, 2, 3, 4, 5, 6, this could be the 7th recession since 1980, if you will. And that's really a precursor to what's going to happen. Now, is that good news or bad news? This is another way of looking at it, sort of the willingness to lend. And so now you have banks having to hold on to deposits and having to sort of lend out less. Here's the knock-on effects of this. Especially in the small regionals. They're going to lend less, which means there's going to be less economic activity moving forward, which means it's going to automatically slow the economy. Is this the intended or the unintended consequence of what the Fed did, keep raising rates on a short-term basis to break something? Well, this is another sort of knock-on effect, like it or not, this is where we are. So the economy will slow, it will then trigger a recession because it has every time, again, historically, you're seeing that where we are. This is not going to be, it's different this time, it's going to be in the next, potentially it moves it up. Everyone was pushing the recession bell, maybe 2023, 2024 question mark. I think it squarely puts us in the 2023 recession camp for the United States later this year. Simply because when the curve de-inverts, that means that short-term interest rates are now coming down and long-term interest rates are sort of moderating. And so when you have that de-inversion, as we're seeing play out right now, that's the signal that, we're 4 to 6 months from a recession and it's imminent. Now, moving forward in equities, if you look at the equity market, obviously financials aren't the best performer year to date, but we're not concerned, especially on the larger financials, if you will, that we have for our clients. In fact, there's opportunities moving forward, not just right now, but we'll be patient and let the market sort of bring us those opportunities moving forward. But also the diversification, large cap tech, mega tech, in fact, is one of the best performers this week. Now, Rob, why would that be? Well, obviously you have 11 sectors of the S&P 500, and that's why we're diversified. We have a balanced approach for our clients, and we have large companies and mega cap companies that, will weather recession. They have plenty of cash on hand, strong balance sheets, and they'll get stronger as a result, because what happens when a recession is the big get bigger and the little guys get washed out. And we'll see that sort of play out in every sector. Now, on the tech sector, the large cap mega techs, if you will, the sort of the pause of the Federal Reserve, are they going to have a dovish sort of hike, meaning we're going to go one more time, 25 basis points next week? Or will it be 50, or excuse me, no hike, but sort of hawkish talk? I still think we're in the camp of from a credibility standpoint for the Federal Reserve, they're going to raise by 25 basis points, but they're going to be dovish. We're going to be data dependent. We're going to be Johnny on the spot. We're going to use all the tools we can to essentially make sure that the banking system as well as the U.S. economy is sort of well within the range. If you look at all the economic data, it's playing into the Fed's hand proactively and positively. So they do have sort of the air cover, but the credibility, we believe that they're going to raise rates, but they're going to be dovish in their talk. So if rates are done for this year after next week, meaning raising rates and sort of maybe potentially lowering rates later at the end of the year, that's sort of what the inverted yield curve or the de-inversion is certain out of sort of forecasting. That means it's positive for big tech. It means it's positive for some sectors of the U.S. economy. And there are places where, yeah, we could see a bid or an opportunity where, hey, listen, even though there's a recession, equities usually forecast a recession about 18 months prior. And we saw the equity markets sort of obviously in the last 12 to 18 months go through some tumultuous times, turnover and high volatility and not the best returns. But now we're seeing valuations come down. We're seeing the economy slow down. We're seeing a lot of layoffs. And then the inflationary data is, again, in the Fed's sort of purview, and it's in the right direction. Now, what this chart is that cost of labor and the profit margins. Now, the blue line right here, and I'll show you right here, is the S&P 500 basically profit margins, their forward PE estimate and their profitability for essentially the S&P 500. And what we've noticed is even though it's a zigzag through the years, it's still on an upward trajectory, and that could increase even further, even though some sectors will have sort of a knock-on effect of a slowing economy. Again, the diversification and balance is key here because some sectors will actually do better. Again, think big tech. They're laying off left and right. Why? Because they're preserving this line, the profitability. Now, this is the most important, essentially, here of all of everything. This is the forecast of the unit labor cost year over year. And this is what the Federal Reserve sort of been working on. And it's been stubbornly persistent, meaning cost of wages, wage inflation that the Federal Reserve is trying to work on is constantly stubborn. It's been entrenched into balance sheets, meaning if it's entrenched in balance sheets, profitability is going to go down. That means the S&P 500 is not going to do well in terms of earnings. And that's what drives stock prices higher long term, the earnings potential. Now, if we see the profitability going up over time because of layoffs, because of cost of capital coming down potentially, but more importantly is the unit labor cost just recently is projected to go down even more substantially as a result of sort of the economic headlines that we're seeing right now. That's a pretty damn good setup for equities long term. So because the profitability will still be there, it'll be preserved, and if unit labor cost is what the Fed's actually trying to work on, come down, we could see potentially an opportunity for equities. Maybe in the short term, we're going to see substantial volatility because we're not out of this banking sort of crisis of, I wouldn't say confidence, but crisis of sort of a lot of small regionals got over their skis and got exposed. And as Warren Buffett said, hey, listen, when the water goes out from the shoreline, you find out who's swimming with or without a bathing suit. And that happens every time in a recession. So that shouldn't be unexpected, if you will. But the forward setup on my scribblegram right here is that profitability could be still in play for U.S. companies, and that's good for equities long term. Short-term volatility brings us opportunity, and that's where we're opposed to take advantage of anything that comes our way, but we're cautiously optimistic. That's our update for today. I know it's long, but I think it's important to sort of talk about the topics, what we're paying attention to, what markets are really paying attention to long term, as you should be too. Thanks for watching, and again, share with friends and family, like and subscribe. Talk to you soon, and happy St. Patrick's Day tomorrow.